Hey, Courtney Smith here with TradeSmith, the video weekly newsletter. And for all you fully paid up members, I've got a ton of new trades here this week. For you freebies, got some new analysis as well. Let's dive right into it, and particularly dive right into this disclaimer. Very important you understand this. All right. So far, the market's behaving exactly as predicted. Something a little bit disturbing, and let's just back up. We're looking at a rectangle formation here. That's pretty clear. And then I've highlighted in a red box something. And here we can see the on-balance volume has made a new low, but the price did not. Now that's a divergence. And it would suggest that we're going to move higher, maybe back up to the old highs that we made around 2,200 on the S&P. The only thing that bothers me is down in the lower right-hand corner, that little down day, that little inside day was on heavy volume. So whichever way we break out of Friday's range is going to be a pretty clear-cut indicator as to where the market's going near term. But right now, I'm going to go a little bit more bullish. My little bearish call is over. Look for a little bit of a bullish price action here early in the week. But I think we're still going to probably head down to 2030. Dow Jones weaker. Dow Jones weaker. Here's the NASDAQ. NASDAQ has been the strongest, but of course we had that big divergence that I talked about, and we sold off perfectly as predicted. Here you can see the little down day on Friday, but it was on very, very heavy volume. I don't really like that price action at all. Seasonality is still remains in a buy signal. Now what that means is that when we're on a buy signal, we want to be taking extra large positions to the upside. So far that's worked out really well. Haven't had any monster winners lately, but all of our winners have been bigger than normal size, and that adds up over time. Seasonal patterns, we went over this in a lot of detail last week, but still, you know, kind of choppy, sloppy through the summer as we normally get. And then maybe around August, we'll start to see another move to new all-time highs. But we got probably a month of really not really much action at all. Yield curve, this is going to be something that's going to stop the market from moving higher. You can see we're at where we were a year ago, and the yield curve has been collapsing ever since. And that doesn't mean we're going to have a bear market, but it does mean that it's going to be difficult for the stock market to gain much traction on the upside. So don't look for any 30% year or 20% year. I don't even think we're going to get a 10% year this year, probably somewhere between 0 and 10. Asset allocation, we talked about the breaking of the little head and shoulders formation. I'm I think the only person in the world that does technical analysis on fundamental analysis. But this is going to cause money to continue to flow out of the bond market and, into the bond market and out of the stock market. So over the near term, don't look for any big moves up, maybe a few days up, as I mentioned at the top of the broadcast. But nonetheless, asset allocation is going to weigh on this market as well. Risk appetite, no big story here. Global shares, we had the big failure top a couple of weeks ago. The market's now dropped below support. We're in a bear market now, lower lows and lower highs, very clear. But we had a little snapback rally on ideas that, what we saw is that the polls, which had shifted in favor of Great Britain leaving the EU, shifted back. And now we're starting to see that the Remain crowd is outpolling the Leave crowd. Now, admittedly, these polls are some of the most, well, we just don't know. In other words, they're not very reliable polls. So we're going to have to look for big surprises on June 23rd when the referendum kicks in. So that's only 5 days from now. That's going to keep things on edge. Bonds continue to move higher, except on Friday. But still, the bull market remains. We've shown you the asset allocation. Also, the rally is occurring on steadily increasing volume. Look down at the bottom of the chart. You'll see that. And that's confirming the bull market that we've got going here. So look for bonds to move higher. But I mean, really, of course, I've said this before. How much higher can they get? This is the highest prices in human history. Well, okay, in American history. Bond key factors are generally bullish. Generally suggesting lower interest rates, with gold and CRB suggesting higher interest rates. But the 10-year Treasury in Germany is the most important factor dominating the bond market right now, and it's suggesting we're going to continue to see this bull market in the bonds. The yield curve, oh my God, look at this. The top line, the green line, that's the yield over the last couple or 3 years, back to 2013. That's the US dollar up at the top, yielding about 1.6%. Under that is the UK at about 1.2%. The blue line is the German 10-year yield, and it's basically at zero. It actually ended up at 0.04% negative. And then the orange line at the bottom is Japan. So all of the major currencies, all the major countries are putting downside pressure on U.S. interest rates as well. So this picture really tells the story. Dollar, look for a breakout here. We're in a pennant formation. Should see a breakout here this coming week. I don't really have a position on. My sense is that we should move higher, but the fundamentals are very choppy. I mean, we're trading at the same price we were back in March. So clearly there's no major trend here right now. Gold, we got up to the top of this rectangle formation. I'm bullish. I think we're going to break out of the top. Here's why. All of our indicators, our key short-term indicators for gold, are bullish. And so look for the market to break above those highs. We broke above them on Thursday, but then we collapsed back down. Now look for the real breakout to occur. And if that happens, you should add to your gold positions or initiate your gold positions. But that's your signal to get more gold. If you've been following our recommendations, you know we've been a bit bullish. All right, oil. I'm still scratching my head here, quite frankly. Market's in a clear bull market, except wait a second, we kind of made lower lows on Thursday. We rebounded sharply on Friday. The other thing is that suggests bullishness is that the down move we had over the previous week was accompanied by falling volume, which suggests that the decline was not being supported by volume. And so Friday's price action is probably the real thing to look at. So look for the market to rebound up to the $52 level. $52 level. All right, everybody, listen. Love having you on here, freebies. All of we've got our great new podcast listeners. Love having you guys. It's fantastic. Hopefully you're getting some value here. And by the way, you can subscribe and get specific trade recommendations by going to that link up at the top. It's a peanut. Less than a Starbucks coffee every day, and I think you can probably make at least $47 off of these recommendations, the specific recommendations, the actionable advice that's in the paid-for version. Anyway, listen, really appreciate having you all here. Fully paid-up members, hang in there. I'll be back with you in just a second.